So Janet Yellen just traveled to China and she had quite a few tough conversations. She told Beijing to stop exporting deflation and to dial down their industrial growth. We of course know this is quite ridiculous. China's big pivot to industry can't be stopped. President Xi wants to achieve his 5% growth target when real estate is imploding. So the only way to do this is to go full manufacturing. Yellen blamed China for the US losing 2 million jobs after joining the World Trade Organization, and that led to the hollowing out of America's industrial base. But we all knew it was the corporations that wanted cheap Chinese labor to boost all the earnings, avoid paying a fair wage to US workers, to lean on underpaid Chinese people for big profits. So that is quite a moot point. But the craziness didn't stop there. She then issued a big warning that is simply unthinkable. Yellen threatened sanctions for China banks that aid Russia's war. And this is really dangerous. It's weaponizing the dollar to a degree that's on par with freezing a country's assets. It might even be worse. And this reminds the world once again of US overreach. Any banks that facilitate significant transactions that channel military or dual-use goods to Russia's defense industry exposes themselves to the risk of US sanctions. And this opens up a whole can of worms. What does she mean by significant transactions? And what is the definition of facilitate? There are so many loose ends here, and this vague description is dangerous. When it comes to trade, banks are normally the middleman. They give credit, they provide insurance and currency exchange. So if a Chinese company sells something to Russia, there's a bank somewhere in between. The bank provides trade finance services. Russia-China trade has tripled since 2015. China imports more from Russia than it exports out. Trade hit $240 billion last year. So Yellen targeting Chinese banks could impact the flow of trade as well. We have no idea how much dual-use goods are being traded between Russia and China. It is suspected to be quite a bit, but tracking it is quite impossible. For example, China is said to increase exports to Central Asian countries like Kazakhstan. The goods then flow onwards towards Russia. We can see this big increase in Chinese exports to Central Asia since the start of the conflict. And it's not just Central Asia, dual-use goods are flowing through countries like Turkey and the UAE. So you can see how far-reaching secondary sanctions can really get. Now sure, cutting Chinese banks off the dollar system might be a deadly blow for Beijing, but it will boomerang back to the US. It will trigger a chain reaction that will frighten every single bank on planet Earth. The spillover will be global. And let's understand the scale of Chinese banks. This includes names like ICBC, China Construction Bank, and the Bank of China, and they are the biggest banks in the world, even bigger than Bank of America and JP Morgan, so their footprint is enormous. Now these are global banks, which means they transact using the dollar as well. They conduct business and trade across the world, which is a big point of weakness, and the main tool Yellen has is to cut away their access to the US dollar system. In other words, these banks can't transact in dollars or they lose access to their holdings, or even worse, both of that happens. And you can see how dangerous this is. Any bank that loses access to dollars by definition is no longer an international bank. The US dollar is the world reserve currency and the world still depends on it. The level of dependence is still mind-boggling. 74% of Asia Pacific invoices trade in dollars, 79% in the rest of the world. For international deposits and loans, 60% is done in dollars as well. Yellen is threatening to cut Chinese banks away from global trade. In the short term, there will be big disruptions to China's trade. Chinese banks finance companies building factories. They ensure oil cargoes being traded. They take deposits from customers. And a big part is done using the dollar. The fallout won't be small. Energy contracts need to change. Western investment into China will stop and access to SWIFT will of course be gone. Now in the short term, this will be painful, but just like Russia, this will force China to reshuffle their banking industry. They will de-dollarize even faster than Moscow. China's economy is bigger than Putin's. They have a lot more levers they can pull, especially when it comes to physical trade. ICBC, for example, has a branch in Saudi Arabia. The intention is to promote the Chinese yuan. China already has settled many cross-border trade with many countries, including Brazil with local currencies. And let's not forget the yuan swap line between China and Saudi Arabia worth $7 billion. This allows Saudi Arabia to exchange rials for the yuan to import Chinese goods. And you can bet this swap line will increase if Chinese banks get sanctioned. Bypassing the dollar in bilateral trade will accelerate. Saudi Arabia's biggest trading partner is China. If dollars are taken out of the equation, MBS will readjust and continue trade. Decoupling with China is virtually impossible, especially when it comes to Saudi Arabia's oil exports. MBS is the second biggest supplier of oil to China. Just last year alone, Aramco exported 86 million tons of crude to Beijing, and this supply accounts for over 20% of their total exports. They have refineries on Chinese soil as well. It is in their interest to see China survive and even thrive. If the banks can access dollars, Saudi Arabia will simply allow them to pay in yuan or Saudi riyals. Local currency trade will flourish. That's why Yellen hasn't fully thought this through. There are so many repercussions that sanctioning Chinese banks is a very big mistake, and this will break the petrodollar system. Oil producers will have no choice but to bypass US dollars to trade with China, and they will do it because they import a ton of Chinese goods. China is the top trading partner to more than 120 countries. That includes Japan, South Korea, and Taiwan, and it acts as an incredible shield against Yellen sanctions. If Chinese banks get cut away from the dollar system, this will trigger a global de-dollarization. It will be out of necessity because countries still need to trade with China. Yellen will trigger the end of the dollar's role in global trade. She will be the queen of de-dollarization, and that's how badly this will backfire. So it shouldn't be a surprise that China is finding ways to decouple from the dollar. Beijing has to do some de-risking in their national reserves. There's an overcapacity of dollars in their holdings. And for China, there's no place like gold to stash their money. China's central bank buys gold for the 17th straight month. Even though prices are at a record high, China increased their reserves to nearly 73 million ounces. Beijing has seen what happened to the Russian reserves. They have been frozen and they're on the verge of confiscation. And if you think Russia's $300 billion is big, China's dollar assets are even bigger. Even though China's dumping their bonds, they still have nearly 800 billion stuck in US debt. That represents a big risk if the economic war escalates. China's assets could always get frozen just like Russia. And we know China's betting big on their industries. They want to replace their collapsing property sector with manufacturing. As China continues exporting deflation to the world, their exports will continue to rise. Just in January and February alone, exports have increased by 7%. And this is money coming into China from the world. It isn't domestic consumption. The demand for Chinese goods is still going strong. Despite major economies in recession, China is still grabbing market share. Their prices are still very competitive. This creates a funny problem for China. As exports continue to rise, they start piling on a ton of wealth. They obviously can't leave it in cash, whether it's dollars, euros, or yuan. Fiat currencies lose value every single year. Everyone knows this by now. In 2023, China's trade surplus has surpassed $820 billion. For almost 5 years in a row, they exported more than their imports. Wealth from the world is flowing towards China. A rising trade surplus means more tax revenue. More tax revenues translates to a bigger pile of reserves. China now has a ton of dollars they need to invest. It's a good problem to have, but it's still a challenge nonetheless. Rolling it into treasury bonds is a no-go, especially after Yellen threatened Chinese banks. Apart from Western assets, China has two avenues to invest their money, and the first is investments in the Belt Road countries. China's engagement with the BRI rose by 24% last year. They spent over $90 billion investing and building in these countries, and that's enormous amount of money sent offshore. It benefits the countries getting the cash, but it helps China park their money outside of dollar assets. They invest in hard assets like overseas manufacturing, assets that generate real goods. China also lends a ton of money to the world directly. For nearly a decade, China has been giving loans well over $100 billion a year, and these are loans issued outside of Chinese banks. It's used to fund projects around the world. Is another avenue for Beijing to invest their dollars. But loans and BRI investments have risks. They have big counterparty risks. Borrowers can always default, and your investments are in another country. Sanctions on Chinese banks can actually block access to them as well. That's why China still needs to invest in gold. And this phrase is why China prefers to buy gold. It is a highly liquid asset. It is no one's liability and carries no credit risk. If sanctions rain down on China, they will still need a stash of wealth they can access immediately without any risk of confiscation or physical blockades. The only answer left is gold. In the worst case scenario, Even if countries refuse the Chinese yuan, they won't refuse gold, and this allows trade to continue. It's important to realize what's driving this rally is not the retail investor, but global central banks hoarding gold. They have been buying for decades, but central banks today are ramping things up. People like you and me, we buy gold to preserve wealth. That's also true for central bank buying. However, gold represents more than just a hedge against inflation. They buy gold to escape geopolitical risks, to sanction-proof themselves. They buy gold to build confidence in their economies and currencies. Even when gold is at $2,300, the global elites are stacking more in their vaults. And here's how serious they are. Even though ETF outflows continue, the price of gold is climbing higher and higher. In other words, retail investors are selling off their positions, but central banks are buying behind the scenes. And this buying is so big that it is pushing prices up higher. This gold rally is very unique because it is coming at a time when interest rates are higher than inflation. If you are to buy a US Treasury bond, you will be getting a positive yield, a real rate of return. Looking at US bond yields, we can see it is well above 4%. Yields on the short end are at 5.3%. US CPI is at 3.2%. So if you buy a short-term Treasury bond, you will be getting at least a 2% return after factoring in inflation. And this should be highly bearish for gold, but yet we have seen gold prices rally higher and higher despite bonds having a real yield. So what is going on here? It's either one of two things or maybe both. Investors no longer trust the inflation figures from the BLS. Inflation on the ground is likely way more than just 3.2%. Anyone and everyone can feel it. If the rate of inflation is higher than announced, that means you are losing buying power even after buying a treasury bond. Yields might not be enough if inflation is at 6 or 7% in reality. However, a bigger worry central banks have is the US debt situation. Buying gold and shunning treasuries is a clear sign of this. There's a big disconnect in the US, especially amongst the elites. We have crazy headlines from Fed economists saying that there's nothing to worry about. The US debt is now $34 trillion. Don't worry, seriously. And this is next level delusion. This is Twilight Zone economics, and global central banks aren't that stupid. The US national debt is going to increase year after year. Every crisis America faces, the knee-jerk reaction is to borrow more money. The '08 crisis saw debt to GDP jump. The 2020 lockdowns increased borrowing even more. And by 2050, the debt will reach 155% of GDP. And consider the situation. The US is funding two wars, one in Ukraine and another in Israel. Biden is planning to unleash a $7.3 trillion budget in 2025. And this endless borrowing and spending will push the national debt closer and closer towards default. Global central banks, they see this, they know sooner or later the music will end. When the default happens, the Fed will print a tsunami of dollars to pay back bondholders, and that will debase the currency even more. Even if the US stops weaponizing the dollar, the fiscal situation alone is one big ticking time bomb. When it explodes and all you have are dollars or bonds, your nation's wealth will evaporate. And that's why central banks are buying gold. It's not some complex scheme, there's no hidden agenda. They are just afraid of US foreign policy and endless deficit spending. So we can expect China to keep buying physical gold. They simply have no choice, and local people in the country are piling in as well. China's gold ETF surged by 30% since March this year, while Western investors are running away. Buying from the Chinese market is supporting prices, which makes sense. Gold for them is still the best buy, and it won't be long before the rest of the world catches up. The longer inflation stays high, and the more the US weaponizes the dollar, the demand for gold will stay strong. So our best friend Janet Yellen is only going to make things worse. Threatening and even sanctioning Chinese banks will trigger the end of the reserve currency. There's no reverse gear left. The only solution she has is to punish China. But let me know what you think. Will Yellen sanction Chinese banks? Will central banks keep buying even more gold? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.